Equity. That's a word we hear a lot, but how many of us know what it really means? Let's go back to the basics and discuss the different types of equity and its value to investors. I'm Kalila Reynolds, and it's time for another episode of Money Mondays JA, brought to you by Proven Wealth. Before we get started, don't forget to like this video, subscribe to this channel, and turn on those post notifications. Also subscribe to my newsletter at KalilaReynolds.com. And while you're at it, check out our other financial news on the website at KalilaReynolds.com/news. Now, equity has different definitions depending on the context. When talking about the stock market, equities are shares in the ownership of a company. So when a company offers equities, it's selling partial ownership in the company. Equity is also prominent in business and in home ownership. Let's dive in. So let's say we started a small water bottling company and we want to know the equity we've put into the business. First, we need to know our total assets. Well, during the course of business, we needed to buy a water pump to supply and fill our bottles. So it's definitely an asset. We found a pump that cost $1 million, but the bank only offered us a loan for $700,000 to finance the purchase. We found the remaining $300,000 from our own cash and money from relatives. Well, this $300,000 would be seen as shareholders' capital or equity. That's how much you've invested in your company. That's your skin in the game. So you get the concept. Now, coming back to equity on the stock market, you can see that it's very similar to equity in small business. Let's say that the assets owned by the company are 1,000 water pumps used for manufacturing. These pumps are used at different branch locations. The total value of the assets would be $1 billion. The company would have many loans outstanding. Let's say that totals $700 million. The remaining $300 million would represent capital or equity from the founding shareholders and new shareholders, in the case of the company going public. An investor can make the choice to either buy bonds or stocks. Buying bonds means that there's a predetermined interest rate and may use the machines as collateral. Buying stock carries more risk, but also more potential profit reward. Now let's look at a basic accounting equation. We know that assets are equal to liabilities plus equity. So that would mean that equity is equal to assets minus liability. So equity would go up if the company is profitable and down if the company suffers losses or pays out dividends. Equity in home ownership follows these same rules, but it's slightly different. The asset would be the house. Let's say this house costs $15 million. The homeowner can get a loan of $10 million from the bank, and you'd have equity of $5 million in the house. Remember how equity in business and the stock market can go up or down. The same happens for equity in home ownership. So when the homeowner pays mortgage on the house to the bank, their equity will increase. If after a year $1 million is paid in mortgage, the equity for the homeowner will increase from $5 million to $6 million because you put $1 million more into the house. Now, if the market value of the house increases, then the equity for the homeowner will increase as well. Remember, that equity is the assets minus the liabilities. So let's say the house's market value goes up from $15 million to $17 million. Then the equity for the homeowner will similarly increase from $5 million to $7 million. It's the same for a decrease in the market value of the house. So if the house's market value goes down from $15 million to $12 million, then the equity for the homeowner, what you have in the house, what you own in the house, will also decrease from $5 million to $2 million. If the house's market value decreases to less than the $5 million equity owned by the homeowner, then they're in real trouble. That's called being underwater. And you'll need to have a serious conversation with the bank to make a plan so that you can get back to positive equity. In the worst case, the homeowner might lose ownership of the house. Well, to recap, equity, whether it's in business, stocks, or home ownership, follows the accounting equation of assets equal liability plus equity. To calculate your equity, just do a simple flip of the equation to get equity equals assets minus liability. Now, here's what's coming up on Taking Stock.
Pulse Investments was the top performing stock of 2020, gaining a whopping 222% in the middle of a pandemic and ending the year at $4.83. We'll speak with Chairman for Pulse Investments, Kingsley Cooper, on the remarkable performance and plans for 2021 and beyond. And later, the analysts weigh in on the latest market developments. They'll tell us their 2020 standouts and outlook for the year ahead. Plus, an assessment of Wigton Wind Farm results and an upcoming stock split for Salada.
Now don't forget to like this video, subscribe to this channel and my newsletter. You can click the link in the description box below. Follow me on Instagram and Twitter at Kalila Ray. I'm Kalila Reynolds. Stay safe.